All right, ladies and gentlemen, it's Aaron Fragnito, your host here of the Passive Cash Flow Podcast. And today we're going to go over a webinar, how active investors can become passive real estate investors. We're going to open up, we're going to broadcast to our network here, let everyone jump on, and we'll get started in just a minute. All right, so my business partner, Seth Martinez, will be joining us shortly. I'm Aaron Fragnito with People's Capital Group. I see everyone jumping on our webinar here today. We're going to talk about how active investors can become passive investors. And we're going to focus on maybe you're just getting started with real estate, you're trying to buy some real estate, or maybe you own a nice portfolio, but it's just not cash flowing, or you're getting tired of managing it or managing a management company. We hear that. We've been in real estate 10 years working with different management companies, and we're going to talk about today how passive investors can, active investors can become passive, and some of the benefits of that. And you might be surprised, actually, the returns that a passive investor can make are comparable to the returns an active investor can make. And we'll talk about how that's possible today, and how working together with experienced professionals in real estate, it can be a safer avenue to invest wisely in real estate in high demand markets. We'll talk about the markets we focus on. And our mission is to transform personal finances and quality of life by creating passive income streams through real estate investments. All right, so I see everyone jumping on here. It's good to see high demand here for real estate education here. Now, we don't sell books or education or boot camps. We focus on working with passive investors and helping them together build a real estate portfolio in high demand markets here in North Jersey. And we're going to talk about how we structure that, how we find our buildings, and how we help those passive investors get the benefits of real estate like cash flow and tax depreciation and wealth creation without having to do all the heavy lifting. So I read Rich Dad, Poor Dad to get started in real estate about 10 years ago, and it completely changed my view of the world and how wealth works. And I learned that how the rich get richer and why the poor get poor, and how wealth builds more wealth, and how you always want to have your money working for you. I also learned that real estate has certain unfair tax advantages that really are great to take advantage of. And if you're not taking advantage of the real estate tax benefits and diversifying into real estate, then really you're missing out on all the benefits that real estate has, which just starts with taxes, tax benefits. So Robert Kiyosaki said in Rich Dad, Poor Dad, and if you haven't read the book, check it out. The moment you make passive income and portfolio income a part of your life will change, as Robert Kiyosaki said. So that was a great book that really helped Seth and I both learn how real estate works, how wealth works. And since then, we built a real estate investment company. We've done over 250 real estate transactions together. And I actually met Seth as a realtor to get started years ago. I got my real estate license to get started in real estate. And Seth's making low offers and working with, I was working with a number of investors, and I was learning from them on how they make their money when they buy and purchase real estate for below market value. That is the most important thing in real estate. Buy the property at a discount so that as you improve the value of it and improve the cash flow, there's more equity. And we focus on equity growth over time here at People's Capital Group. So we got established in 2013. Seth Martinez runs the operations. I'm in charge of investor relations. And Seth, you want to talk a little bit about how you got started in real estate?
Sure. Thank you, Aaron. All right. So, I met Aaron in 2010, as he said. And before that, I had a healthcare business in New York City, totally unrelated to real estate, and sold the business in 2009, stayed on for a year as a consultant with a new company. And during that time, I tried to decide what I wanted to do, and I just ended up in real estate. And one of the main factors was Rich Dad, Poor Dad, a book I read at that time. Coincidentally, at the same time Aaron read it, and a lot of people read it. Unfortunately, a lot of people haven't read it, and we recommend people do read it. But it does change one's perspective on investing, and certainly changed mine. And we got started, I got started, as Aaron has said, helping me buy properties as my realtor. We realized we worked well together, and we started buying properties together. And over the course of 10 years, we've actually started helping other people invest with us and together, and making it easier for people to invest who may not be doing real estate full time, who may have a full-time job themselves and don't have, again, the experience or the time to take on another job, but yet they still want the investment benefits of being in real estate. So we help people do that while helping our company grow. And it's worked out very well. And that's what this webinar is about. So we look forward to discussing it with you.
Great. Thank you, Seth. Okay, so what's our agenda for today? We're going to, number one, focus on why do people invest in apartment buildings in New Jersey, why we prefer New Jersey apartment buildings, and how we help active investors that are actively buying real estate, maybe from us. We also have a wholesale division. We also flip houses, or they're just actively managing a portfolio or managing a management company. We'll explain how we work with those investors and why we focus on investing in New Jersey apartment buildings. Number two, why do we prefer syndicated investing? That's when you pool capital together. That allows smaller investors to get into larger buildings that produce better tax benefits and safer cash flow over time as well, more consistent returns. We'll talk about the benefits of larger buildings over smaller buildings. And number three, why do people value PCG's service? So Seth and I have created a nice turnkey experience here for our investors where they can enjoy the benefits of real estate without doing all the heavy lifting. We're going to talk about how we created that experience and what our investors value with by working with People's Capital Group here, and how we've been doing that for 10 years in this market. So let's talk a little bit about the Corona COVID-19 market impact review here. Seth and I have a house flipping business as well. We flip single family houses. That hit some challenges over the last few months, but now it is very hot again, and we have bidding wars on some of our single-family houses. So, that could be a hit-or-miss part of the market. We've been doing it for years, but we actually prefer apartment building investments. Right now, our collections are around 90%. We're still cash flowing on our real estate very nicely, and long-term, it's easier to build wealth with apartment buildings. It's more manageable, it's more consistent than single-family houses, and we are transitioning our business over time to focus more on the apartment building side as we have our in-house management company, and we have a good infrastructure here to allow investors, passive investors, to take part of apartment building purchases in high-demand markets in North Jersey. Self-storage is another space of real estate we like, but we're looking for opportunities there, but that is a little different. And people are also going to pay their rent before they pay the self-storage rent. Office and industrial. Office is very soft. It's been soft for years. Industrial warehouse space is strong, but we don't really focus on that. We like to stick to what we know here with apartment buildings and flipping houses in North Jersey markets. And then you have retail, storefronts. Storefronts have been hit very hard by online shopping, and that's not a space we're very bullish on either. So we stay away from storefronts unless it's like one storefront with many apartments or condos above it. We prefer residential apartment buildings. Hospitality and senior housing, that is a good growth space. It is also saturated with a lot of institutionalized money from hedge funds and whatnot. So the cost to get into that space tends to be higher. And we find more opportunities with mismanaged apartment buildings in North Jersey here. And that's what we're going to talk about today. How we find those, how we structure those, and work with investors that are actively managing and owning real estate that want to become more passive, but still get all the benefits of real estate. So when shopping or looking around for a good syndication to invest in, a good syndicate, and that's what we are, we're a real estate syndication where we pool capital together and buy a large building that's professionally managed. So when you're looking for the right fit, you want to make sure that you're planning a strategic investment strategy here with the pandemic in mind, right? We're looking at a lot of movement out of New York City into New Jersey right now. We're looking at people looking for more affordable housing. The cost of housing is pretty high in New Jersey, New York. So we try to buy middle of the road properties. But you always want to educate yourself on what's the right fit for your investment needs. Where do you want to invest in up and coming markets far away from where you live or close? But the most important thing is work with experienced professionals, right? Whether you're investing in beachfront new construction or you're investing in turnkey apartment buildings in high demand cities, you want to make sure whoever's managing the real estate and working with the investors and what their track record is, what their experience level is, and are they transparent? Do they know what they're talking about? Do they know what they're doing? Have they done what they said they were going to do with other projects in the past and hit those targeted returns or done better than that? And so always want to work with experienced professionals. The truth is you can make money in real estate in a lot of different markets in a lot of different ways. But what we find is that it's really about the management of the building and how well the management company and the operators execute their reposition or their value add strategy. Things to take into consideration when you're looking to invest in the market: the history of the market. Okay, what's the demand been for the last 10 or 20 years? Where's the demand going? That can tell a story often. What are the cities around that city doing? The degree of risk in your investment, right? Are you looking for higher risk investments that produce higher returns? Or are you looking for lower risk investments that produce more modest returns? We try to find opportunities right in the middle where there is a mismanaged apartment building, but there is opportunity to build a very strong returns over time. But look at the degree of risk in the investment and what are you comfortable with, and diversify that risk. Always diversify. Location. So proximity to where you live. A lot of our investors like investing near where they live in New York, New Jersey. They're able to look at the real estate. Does that matter to you? Is that important? Or are you focusing on chasing the next growing market? Is that the most important thing? So what are you looking for in a real estate syndication? What's important to you? And you always want to look and shop around properly, make the right decision, the right fit for your investment needs. And we're going to talk here now about why do investors like New Jersey. So we like New Jersey, and our passive investors like New Jersey. I see there's a question here that just popped up. By the way, if you have questions, definitely write them in the chat or in the Q&A. And I'm going to answer all the questions at the end here. All right. So we love questions. I'm glad to see a question pop up there. We encourage more of those, but put them in the Q&A or the chat, and I'll be able to respond to them at the end of the presentation here. I will answer all of your questions at the best of my ability. So New Jersey rents here are growing and continue to grow. Okay, the last problem we have is renting out our units. We have a line out the door to rent our units, and rent is continuing to grow even in this difficult time right now. And that's really a testament to the strength of the North Jersey market and the strength of our management system and where we buy buildings in high desirable markets. Rent in Newark has raised almost 7%. Berkeley Heights, almost 18% in 2019. So rent continues to grow. We just bought a $2 million building in Berkeley Heights last year. We invest in Newark very actively. We love Newark. New Jersey is a highly skilled workforce, ranks number 1 in education, number 3 in median household income. So we're very well educated here. We're high earners. There's a lot of wealth. There's a lot of opportunity. But the hardest part is finding a good discounted property. Many real estate investors and operators cannot find that here in New Jersey. We have the ability to find that and the ability to manage it. But the hardest part in this market is finding a good opportunity. Since there's so much wealth, we actually have more investors than opportunity often, which is a good problem to have on our end. So the state here is home to 20 Fortune 500 companies, number 1 in drugs and pharmaceuticals, number 2 in direct foreign investments. A lot of activity here. A lot of companies are moving from New York into New Jersey. New Jersey offers a lot of the same amenities and transportation options that New York has, nightlife, good housing, safe neighborhoods, mountains, beaches, interesting cities. So we have all those amenities here that New York City offers, but New Jersey tends to be a more affordable option. And a lot of people are moving from the Manhattan and the boroughs of Manhattan to New Jersey, we see, and that helps our rental growth and that helps demand for housing here in New Jersey. So continued here, why do people invest in New Jersey apartment buildings? So our investors are seeking legal tax shelters. That's tax depreciation that the building offers, as our investors own a part of the real estate. So they get the tax benefits and they get the cash flow and the refinance capital, but of course they don't have to do the day-to-day operations. And that allows our investors to confidently fund important occasions in life, like weddings and vacations, because it's a more predictable asset class. It's easier to predict where our cash flow will be for our investors. It's easier to predict the value of real estate over time as we lower our expenses and build our forms of income. So the more net profit the building makes, the more value the building has. And we harvest that value over time with a refinance, which we'll talk more about later in this presentation. So our investors are seeking low-risk investments, and by spreading out the rental income amongst many units, vacancies hinder us less. So buying a 25 or 50 unit or even larger apartment building is a safer investment than a small multifamily. We'll break that down in a second. Our investors are seeking properties with an easy commute to New York City. Our tenants are looking for that as well. We buy properties within cities that allow you to commute into Manhattan in less than an hour, but they're on the New Jersey side. We're very bullish on, Plainfield and Patterson and Newark and Jersey City and Elizabeth. We've done well in all these cities, and we continue to do well. And the demand to live in these cities, if you know where to purchase and how to purchase, continues to grow consistently. Although we don't project that in our targets, we project very limited growth over time. We want to be safe. We want to be very conservative with our projections. So our investors are seeking well-managed New Jersey apartment buildings that fare well in recessions. We find in this difficult time, we're around 90% collections, which is really a testament to our management company and the strength of where we purchase real estate. The tax depreciation allows our investors to write off that cash flow, so the cash flow is tax-free. And we also complete a refinance of the capital. So that is another tax-free scenario as well for our investors. We'll break that down in a second. And because of the tax benefits of real estate, it really is an asset class that gives you an unfair tax advantage. And we encourage our investors to take advantage of all the tax benefits of real estate with a buy, renovate, refinance strategy that we execute on our buildings year over year. So our investors are generally long-term, although there is options to exit every 3 to 5 years upon each refinance. But our investors look at us as a long-term option to fund important occasions in life, like college, weddings, and travel. And this allows our investors to be more confident in their returns down the road and be involved in a more predictable, well-managed asset class here in a high-demand market that holds its demand through good times and bad. So as I was saying before, vacancies hinder larger buildings less. And the reason for that is if you have a 2 or a 3 family property and you lose a tenant in that, well, you lose half your income or a third of your income, and it's tough to cover your costs then. If you're investing a small investment into a large building and it's a 25 or 50 unit building and we lose some tenants on that, there's some turnover. In that case, the vacancies really hinder us a lot less, and we can continue to cash flow even with a number of vacancies as we turn over the building. So larger investments, also things like capital improvements, if a boiler breaks, it costs $5,000 to fix it. Things like that happen with real estate. But if you own a 2-family property and you spend $5,000 to fix your boiler, well, that can be a whole year or two worth of net income on the building. So with a 25 or 50 unit building, you have $40,000, $60,000 rent roll per month. So your repairs hinder you a lot less, and they just tend to be a better cash flow machine and a safer long-term investment than smaller multifamily. We know that because we've owned a lot of small multifamily getting started. We owned about 100 units getting started. And we bought a 25 unit. We said, wow, it's a lot easier and a lot more profitable to own 25 units under one roof than it is to own 25 units over 15 roofs. So another thing is Seth and I personally guarantee the mortgage to allow our investors to, we get great terms on the mortgage by personally guaranteeing it, but it also prevents the investors from having to do that. So if you were to buy a building yourself or with some friends and family, in that case, if you were to get a mortgage on the property, which is basically required to cash flow on real estate, you want to leverage your down payment. Well, to get that mortgage, you'd have to personally guarantee it. That is not something you really want to do as a borrower, but Seth and I personally guarantee the debt. It's good debt, it's long-term debt, a low interest rate, low closing costs because we personally guarantee it. And that means our investors don't have to. So we personally guarantee the debt, so our investors don't have to. We are on the hook for the mortgage. You better bet we're committed to our project and to reach those targets because we are personally guaranteeing that debt. And that's good debt over time. We obviously have confidence in the project, confidence in our performance to complete the project successfully. And by personally guaranteeing it, we get great terms on the mortgage. The lower the interest rate, the lower your closing costs, the more our investors can cash flow on the building. So it's really a win-win for our investors there. So we focus on New Jersey apartment buildings with easy commutes to New York City. We bring in a lot of millennial rental demand. Newark, Patterson, Passaic. We've done very well in these cities through the years. You want to pick and choose where you invest, but if you invest in the right areas, near opportunity zones, near downtown areas, near areas where there's cranes in the air and developments coming in of Class A and Class B real estate, we buy around those cranes in the air. We focus on mismanaged apartment buildings around those high demand pockets of these cities. and we're able to purchase at a discounted price by looking at a lot of properties. And of course, the management of the property long term allows for consistent cash flow and rental growth. So number two, why do people prefer syndicated investing? Okay, so people do not want to manage the property. It's plain and simple. Real estate's a heavy lift. It's a management intensive asset. And if you don't know what you're doing with the management, or you hire a management company and hope they're going to treat your baby the way you want it, you might be in for a bit of a surprise. If you are an active investor and you own real estate, you may have hired a management company and they did all right, but when you buy a mismanaged apartment building, you got to reposition the building. There's a lot of moving pieces. We're finding out more ways to make income on the property, finding out ways to lower our expenses. It's not just collecting the rent and calling a plumber when the pipe leaks. There's a lot to it. And really our competitive edge is our management company. This allows our investors to get quarterly passive income checks, a clean exit strategy, an option to exit at each refinance. And by syndicating the investment, investors can get started with as little as $30,000 into a $3 or $4 million building, where normally, $30,000 investment would not allow you to purchase such a large investment. But by syndicating, we pool the capital together and we spread out the risk. So our investors like the idea of tapping into expert real estate knowledge, being lifted up above the pitfalls. And Seth and I have been in this market for over 10 years working together now. And we've learned from our mistakes over the years. We've developed a nice turnkey experience where investors can own real estate in this high demand market without taking all the risk or doing all the operations, any of the operations. So, and therefore our investors value the free time. They have no interest in securing the complex financing, personally guaranteeing debt. It's taken years to build these banking relationships, and this allows us to get really good terms on the debt on our properties. So once we buy the building, we force equity into it. What does that mean? Well, that means we lower our expenses. We find out more ways to make income on the property, maybe parking or storage or laundry in the basement. We also renegotiate leases and increase the rent roll. And then we do a refinance every 3 to 5 years. And this allows our investors to not only get a large lump sum of capital as we refinance the building, as we built value into it, and then we refinance to harvest that equity growth and split that up amongst the investors. And this also gives our investors an option to exit at each refinance every 3 to 5 years. So the best tax strategy is to stay invested long term, as we do a 1031 tax deference down the road. But our investors also have multiple exit options, and that allows our investors to have the flexibility of staying invested in a building or exiting in a building, getting back their initial investment, keeping the capital from the refinance, keeping the capital from the cash flow, but there are tax consequences to exiting the investment. So the better tax strategy for better internal rates of return is to stay invested long term. If you're a qualified investor, we'll talk to you more about that in the next step. So we'll continue here as people like the idea of investing, being lifted up above the pitfalls by working with experienced investors. Seth and I will invest up to $10,000 a month to find the right opportunities. We'll look at 400 properties sometimes in a month to bring our investors one good opportunity. So there's a ridiculous amount of work behind the scenes to analyze these properties and then do multiple levels of due diligence. Once you hone in on a good opportunity, we have multiple levels of due diligence to make sure that each opportunity is the right opportunity for our investors, and the reposition strategy is going to be executed with as little snags as possible. We will also, we have a network of about 10,000 people and investors and real estate professionals. We have 3,600 plus people in our Meetup group. And we focus on educating our investors, but we do not sell boot camps or CDs or books. We focus on honing in on our market, improving our craft every single day, being transparent to our investors, and producing returns that are better than we target, under promising and over delivering. So we've secured financing and funding over 250 properties. We over $40 million. We manage about a $10 million asset of our own real estate right now, over 75 rental units. And right now we take on the risk of repaying the bank to make sure we're hyper motivated to remain vigilant on each project. And I'm going to have Seth Martinez, my business partner, who's in charge of operations, talk about why people value our service here at People's Capital Group.
Thank you, Aaron. All right. So why do people value our service at People's Capital Group? Well, it says here, aggressive calculating business model. We've developed this over many years, trial and error, learning what works best, and then sharing those models and those systems with our clients and our investors. Okay, so as we go into some of the details, there's about 3 parts to this, but we want to set a high standard for everything we do, okay? And it starts with how we find our deals. We spend a lot of money marketing, as it says here, historically around $10,000 a month, finding great deals, and then sharing those with our investors. If we only rely on realtors, yes, you can get a good deal here and there if you have good relationships and you cultivate those relationships. But by doing your own marketing and knowing how to market and where to market, you can get even better deals. And that's what we do at People's Capital Group. And again, we share those with our clients. And another reason why our clients value our service. Some of the not so good deals, we actually end up selling off. So there's a secondary market for that. But our main focus is finding great deals, apartment buildings, mismanaged properties, like Aaron said. And again, just sharing those with our selected networks in our network. Okay, and then another part of finding a good deal is just looking at a lot of properties. Aaron mentioned this as well. Our average typical month is roughly 400 properties that we look at, and that doesn't mean we go to every property and drive out there and do an on-site visit, but we do look at them online. We want to be efficient. We've gotten the process down to around 3 to 4 minutes to evaluate a deal, sometimes less. We do it with spreadsheets and just using our experience and kind of combining it all together. And again, that's a tool that we share with our clients. And really what we're doing here is we're creating, as Aaron had said, a syndicated opportunity. So people come to us, they leverage all of our experience, our history, our knowledge, our expertise, and our deals. And we put in a syndicated model where they take advantage of the benefits of owning the real estate. And our ultimate goal is to create all the benefits for them. So passive income, the tax depreciations, the cash flows, and the equity growth. So we're going to talk about that a little more, but it all starts with finding a good deal. Okay, on the next slide, we have what do we do when we get a deal? And again, another thing that our clients like about what we do. So our main goal is to create value or add value to the property, and we do that in 2 ways. First way is increasing rents. So as leases come due, we want to increase the rents. We also want to know what the laws are. There's rent control, there's other laws. It's in New Jersey, at least, it's delegated out from Trenton to each municipality. So we do some due diligence before we buy the properties. And we want to know, what is this municipality's policy or regulation or law on, say, rent control? Again, every town is different. Some towns have no rent control. Some towns have a lot of rent control. Some have moderate. So we want to know that going in. As leases come due, we want to raise the rents to market value where possible. In some cases, we don't even buy the property. If the rent control is too crazy and too high and too stifling, we just won't even buy it, and that'll save a lot of headache in the long term, because we want to raise rents as they come due. We want to do it fairly, but again, market rate. So typically it's roughly 3 to 5%. Another thing we do is we want to decrease the expenses. That's the second part of creating value. And we bring all of our expertise, our experience, our contractors, our relationships. And as leases come due, we want to separate out the utilities. A lot of the buildings we buy, they're not separated out. And what happens is the landlord is paying heat, as Aaron had mentioned, or utilities for the entire building for all his tenants. And if he had just separated out the utilities, his expenses would be lower because his tenants would be paying their own utilities. Could be heat, could be electric, could be water, could be both, all three. So we want to separate out at least the heat and the electric when we buy these buildings if it isn't already separated out. And we want to do it professionally, up to code, and with good workmanship and with good contractors. And so by increasing the rents, decreasing the expenses, we're creating more value, more profit, more net operating income. And we share that with our investors over the course of the investment. Okay, and again, that's a tax-free event at the end. So the number 3 here is the power of property management. So you can find a great deal. You can technically know from a book standpoint what you have to do, raise rents, decrease expenses. But you need to have a good property management company, good contractors, good systems as a business to know how to do it effectively, efficiently, professionally. And that's what we bring to the table, as Aaron had mentioned, from a property management standpoint. And we built our property management company over the course of over 5 years. We learned the hard way. We had trial and error. We started out with higher delinquencies and vacancies and lower rent collection rates than we do now. Now we have some of the best in the business, close to 100% before the pandemic. It's gone down a little bit, but it's going to come back up. And again, we share that asset, which is property management company, with our clients that we choose to work with. And in addition to property management, we also want to be mindful of, as I mentioned, the construction situation. So each building that we buy, we want to know ahead of time, by doing our due diligence, how much work does the building need. In some cases a lot, in some cases little. So we carve out a budget prior to buying it based on our due diligence, and we allocate that budget over the course of the first few years or so to make those repairs that are needed, and to do it with professional contractors who we've had long-term relationships with. Again, something that takes, as I said, a lot of time to create and to develop. So newer investors who come into real estate, some of our competitors, or just people that compete with us who didn't take the time to cultivate relationships with their contractors and other professionals, we see them suffering sometimes because they're using contractors that aren't up to par or aren't as professional as they should be. Another important thing that people like and value about our service is we only manage our own properties, our investors' properties, and we don't distract our management company with other opportunities to manage buildings. Sometimes people do come to us, other investors, landlords, and they say, well, I see you guys are doing well. You have high collection rates. You do things with professional contractors. Can you manage my property? And we politely turn them down because we really want to focus all of our energies like a laser on adding as much value to our own properties with our investors as possible. And our property management company is really there as a tool to extract the most value out of our properties. And we don't want any distractions. And again, the ultimate goal here is to create the value, create consistent cash flow, passive income over the course of the investment. But that's what we need to do to do that. Those are the three things. If you go to the next slide, what happens at the end? I know Aaron touched on this. What's the exit strategy? We want to make it as easy as possible for all of our clients and investors to exit a deal when they're invested. And so they have two choice. The ball's in their court. At the end of an investment, typically 3, 4, 5 years, when it's time to refinance the property, it's their choice. Do they want to stay in the investment for another 3 to 5 years, or do they want to exit the investment? It's totally up to them. We just usually need a 90-day notice or 120-day notice, depending on the property. And at that point, they can, again, stay. They can take all their profits, just keep the principal in the investment for another term of 3 to 5 years, or they can take the profits and also take the principal. It's up to them. Okay, and then just lastly, we have been working with roughly, I'm going to go to the next slide here. Yeah, so we've been working over the years with dozens and dozens of investors. We've raised millions of dollars. A lot of our funds and our investors have recycled their money many times over, sometimes investing 5 times, 6 times, 10 times. At this stage of the game, we're a growing company. We're looking to expand. There's a lot of opportunities out there if you know where to find them. And we're looking to help more people get involved to make it a win-win situation. So we're going to be expanding the number of investors we work with. And there is a process to qualify. We don't work with everybody. There's an interview process. There's a vetting process. But if we do choose to work with you and we think it's a good fit, minimum investment there is $30,000. And we want to, again, expand the opportunities out there and help as many people as we can while meeting our company's goals as well. So, Aaron, I'm going to hand it back to you.
All right. Thank you, Seth. So I'm going to go over 2 quick case studies here, and we'll wrap up for the morning. And I'll answer all the questions. Again, if you have any questions as we go along, that's great. Please type them in the Q&A in the chat. I see we have some already, and I'll be sure to answer those at the end of the presentation here. So, okay, so let's talk about a couple of case studies here. We're going to talk about a smaller building we bought, renovate, and refinanced twice now. And the investors not only made back their entire initial investment, but they continue to cash flow on the building. And we'll talk about a 25 unit we bought and sold and the benefits that how our investors fared on that investment as well. So here's a 5 unit in downtown Newark near Rutgers University that we bought in 2013. We purchased a lot of real estate around that time in Newark. And I remember people saying, well, you know, Newark has bad schools and high crimes. Why would you invest there? And that may be true, but there are tons of opportunities in certain pockets of Newark and other inner city areas in New Jersey. And if you know where to look and you know who to connect with, we have lots of landlords in our network and brokers and wholesalers. Then these opportunities, they're not on market, they're off market. We bring off market opportunities to our investors. You can't just go on the internet or the MLS or call up a local broker and find these opportunities. These tend to be pocket listings or wholesale properties. That means an investor has it under contract and he's going to essentially assign the contract to us. And that's what this purchase was. So it was an off-market opportunity. Off-market opportunities are the best. They tend to go for the lowest prices for the buyer because not everyone knows about them. When you have an on-market opportunity, well, everyone knows about it. It's on the internet. It's all over the place. It's on the multiple listing service. So therefore, you have more buyers and more bids. And as a buyer, you end up paying more. So the way you get discounted real estate in any market is by going off market, having great relationships with brokers that are going to bring you the listings they have first before they put it out to the open market. That's how it works in commercial real estate, not as much in residential. But in commercial real estate, we like working with wholesalers and brokers and property owners very closely so that we attract off-market opportunities, and that's exactly what it was. The asking price was $130,000. We were able to purchase the property for $110,000. So we got about 15% off the purchase price right off the bat. We were able to capture $20,000 of equity. We put $30,000 into the building, which is not a lot. Even for a 5-unit building, which is kind of a smaller property, a $30,000 repair budget is not a whole lot, but we keep our renovation costs low to, of course, keep our costs in total low. The less you invest, the more returns you can make on a property. But we do the necessary things to bring the building up to code, up-to-date appliances and energy efficiency, and make sure that the units are nice and well-kept and nice, clean, attractive apartments to move into with the necessary whistles and bells that call for that area. And we were able to improve the value and the income on the real estate and put a small amount of investment, about $30,000 into it, and then get it fully leased up and cash flowing. And we turned around and refinanced the building for $310,000. It appraised for $310,000 1 year later. So we purchased it for $110,000. We put $30,000 into it. So into it for maybe $140,000, $150,000 with closing costs. And then we were able to get it to value appraised at $310,000 a year later. So we were able to pull out about 70% of that new appraisal value, so say about $200,000. Not only did the investor make his entire initial investment back on the first refinance, which is not always the case for larger buildings, but he was also able to we refinanced again in 2017, split up another large lump sum of capital, and that allowed the investor to get paid 2 large lump sum payouts on the property. The investor continues to own equity and earn tax depreciation from the real estate. I see there's another question to pop up. Keep them coming. And that allowed our investor to not only make back his entire initial investment, plus returns, plus cash flow, plus tax benefits, but to this day, the investor continues to earn cash flow from the real estate, get a K1 at the end of the year, allowing for tax depreciation to write off that cash flow. And we're right near Rutgers University in downtown Newark. So I haven't had the property appraised in a few years, but I would venture to say it's worth a lot more today than it was even in 2017. So who knows, there might be another refinance in the cards down the road. So here's another property, 25 unit in South Jersey. This was about 90 minutes south of us, and there were some management challenges with it. But we were able to buy and sell the property for a nice profit. We purchased it in 2014 off market from a broker who brought us the property directly before bringing it out to his putting it on the market, because brokers know we're capable of closing quickly. We're cooperative buyers who are gonna strike with integrity, and brokers appreciate that because they like buyers that are straight shooters. So in this case, he brought us the deal off market, just like the last deal. It was brought to me by a wholesaler off market. And that's how you make your money. That's how you buy these properties at discounted prices, by knowing the right people, right? It's kind of like who you know. It's also what you know. But in real estate, it's a lot of who you know. So by getting the property off market, we were able to pay $1,075,000 for it. It appraised at $1.2 million. They were asking $1.2 million. So we were able to capture about $125,000 of equity from day one. And that's our job here. Seth and I, our job is to find these properties at discounted prices and purchase them to create equity from day one. That's why we look at so many properties. That's why we spend so much money on marketing and continue to build our relationship with wholesales and brokers every day. And we secured a bank loan at 75% of the purchase price, 4.5% interest. These days, we're getting interest rates below that, way below that, around 3.75 or so, or even lower. And we get mortgages around 70%, not 75, to just do a little less leverage. We had 4 investors bring in $100,000 each. It's not always that clean. Sometimes we have a $30,000 investor and a $330,000 investor. So in this case, we had 4 investors at $100,000. We did a 40-60 split with us owning 40, the investors owning 60. And we sold the building in 2017 for $1.35 million profit. For $1.35 million with a 26% profit. We forced the asset up by 24% over a 2.5-year period. And our investors walked away with a return around 10 to 11% cash and cash return on this building from the purchase and the resale from it. That was an annualized return. So I think we projected around a 9.5. We were able to hit above that target. And that's what we always aim to do, is under promise and over deliver and hit over that target. So when we go to underwrite a building, we're extremely conservative with the building, and that means we set the bar at a very attainable level, and we actually execute with our management company and our resources here in this market. We're able to normally do better than projections, and that's why our investors keep coming back year and year again, because we project an easy attainable target and we hit over that projection in reality. And that is what you have to do as operators, is always say, okay, listen, things are going to go wrong. We're going to assume worst case scenarios, and we're going to put numbers out there that assume worst case scenarios. And then we're going to go ahead and do the best we can with our resources. And we're usually able to do far better than those projections. So we also work with a lot of self-directed IRAs. We're very IRA friendly, and you can actually work with an IRA custodian to self-direct your IRA into real estate. We do a webinar on this every month, so I'm not going to get too much into it right now, but essentially we can connect you with an IRA custodian who's going to work with your IRA and move it to their group and then move it into real estate as you direct them. There are rules and regulations. It's not a way to pull from your IRA early or beat the tax man on the IRA. It is a way to build your IRA stronger, to actually take part of your IRA or your solo 401k and take control of it and put it into an asset that you choose, instead of just maybe moving it through the stock market and not seeing tangible effects of your IRA. So if you want to learn more about that, you can learn more on our website, but you can self-direct your IRA into real estate with People's Capital Group, and about a third of our investors actually self-direct their IRA. We're a very nice fit for IRA investors, because we invest in high demand markets with a long-term strategy, which is a good fit for IRAs. So I'm going to talk about 3 types of investors we work with here to kind of explain how passive investors, what type of passive investors we work with here at People's Capital Group. So here's an example of an accredited investor, a high income earning investor, someone that has a net worth of over $1 million, not including their primary residence, or earns $250,000 a year individually or $300,000 with their spouse, and has the expectation to earn that next year. That is an accredited investor, okay? If you don't make that financial cut, then you may fall in the category of a sophisticated investor. We can also work with sophisticated investors. Those are individuals that have the minimum investment of $30,000 plus some. We only would ever take half of a available investment amount from an investor, and also understands the investment opportunity, has some experience in the asset class. That would be a sophisticated investor. So we can work with both smaller investors getting started, such as sophisticated investors, and also more established wealthy investors, such as accredited investors. We've developed a fund that works with both small and big investors, accredited and sophisticated investors. So in this case, this is an accredited investor, probably has a large stock portfolio that gets stock dividends. Now, real estate produces cash flow, which is similar to dividends, but dividends are taxed, where in real estate, you can write off the cash flow with tax depreciation. That's one of the main benefits of real estate over stocks. So a lot of investors diversify out of the stock market to get away from the volatility, get better tax benefits, and invest passively with People's Capital Group, because it's a comparable investment avenue as far as a passive investment, where you receive monthly updates on your property, learning what's going on with the reposition, quarterly financials that break down the cash flow and the balance sheet, the profit and loss, the distribution sheet, so you understand what's happening in the property every month with the updates and see it in the financials that come with your quarterly cash flow check. So our investors really enjoy learning through the process, but also diversifying out of that stock market, getting into something more predictable, especially with the refinances, nice lump sum of capital there, and more recession resilient as we've seen during this tough time with collections strong, cash flow strong to our investors, even during this pandemic. So let's talk about active real estate investors, okay? This is ideally what the presentation is focused on today. Here, we're really focusing on how active investors can become passive. Since we flip houses and we wholesale houses and we sell houses to active investors, a lot of them say, hey guys, I just came out of a flip. I have an extra $50,000 from it. I'm kind of getting nailed on taxes. I'm working my butt off. What do you have as a passive investment opportunity? And when those active investors invest passively with People's Capital Group, we're usually able to earn them returns that are pretty comparable to what they were earning being the operator, running around, managing their holdings, managing their property, or managing a management company. So because of our system here and our boots on the ground and our strong infrastructure, we produce returns that are similar to what active investors are earning doing all the work themselves. There's also the benefit of pooling capital and buying a larger property, and that benefit allows investors that are active to team up with PCG passively, not have to manage the properties day to day, spread out the risk by investing in a pool of capital that buys a large building, not be on call for the management. Oh my gosh, what a headache a property management can be. And of course, with the larger buildings not being affected by things like vacancies or recessions as much. And of course, tax time. We try to make tax time as painless as possible for our investors. We have a whole CPA firm, bookkeeping firm, third-party firm that does all of our bookkeeping, all of our tax prep and tax filing. So our investors are hands off. And if they have a CPA, our CPA can coordinate with them for tax time to make it quite easy and as painless as possible, because we know one of the hardships of owning real estate for any investor, any wealthy individual trying to build their wealth, is taxes and tax time. So we try to make that very easy for our investors. And we work with professionals here that have financials and taxes completed very quickly around tax time. All of our investors get a K-1 at the end of the year. They all own real estate. We start one LLC for each purchase, one fund for each purchase. So you're investing in a specific building with specific updates for qualified investors only, of course. And some of our investors do self-direct their IRA. Not only do they like the idea of taking control of their retirement account, building it stronger, building it faster, creating more value into their retirement account, but also seeing their money make a difference in an inner city area here, local communities here, Newark, Patterson, Jersey City, Elizabeth. If you live in New Jersey, you know these cities, you know that putting your IRA, your hard-earned capital, helping improve these buildings, being able to drive by the building and say, hey, my money's improving that building. It's made it go from a mismanaged apartment building where it's not very desirable to live to a nice, safe building that smells nice and looks nice and people are happy there and improves the neighborhood one brick at a time. And that's what we do here at People's Capital Group. We really try to improve some of these areas one building at a time, and that allows us to help our investors see actual tangible results with their IRA or their capital. And I think that's one of the main benefits the feedback investors give us. That's one of the main benefits they like about us. There's not a whole lot of syndicators doing New Jersey, right? They might be pooling capital in New Jersey. They might have their office in New Jersey because there's a lot of wealth here. However, they're probably buying properties out of state. And there's nothing wrong with that. It's whatever the strategy is, it hopefully works out for them. But we found that when you pool capital together, put your name on the line, and then go out and purchase 5 or 6 states away in an emerging market, the challenges with that are that you're going to hire a management company and be at the mercy of the management company. So we didn't like that model, and that is one of the biggest flaws in the syndication model. So we created a model where we buy local, we manage local, we own the management company, and this allows investors to self-direct their IRA or move their capital in here with the understanding that it's a safer, longer-term investment because we manage it in-house That gives more control of the asset on our end. The more we can control an asset, the more we can make the asset earn positive cash flow, reach those targets on the refinance, and execute year over year for our investors to keep them satisfied. And that's why our investors continue to reinvest time and time again. We try to bring our investors a new opportunity every 4 to 6 months. Quite frankly, the hardest part is finding a good opportunity in this market. So we have good relationships with investors. Putting the capital together is the easier part. But right now, we do have an opportunity that we're starting to present to our passive investors. So here's some client satisfaction, some testimonials. We worked with over 30 investors. We have about 20 lined up as well. There is a qualification process. We don't work with just anyone. You have to be qualified. There is a qualification process, and we're going to talk about that here as well. So that's about it for the day. But if you do want to learn more about how to qualify to be a passive investor with People's Capital Group, if you want to actually break into this market, maybe you own some real estate in New Jersey or out of state, or if you're trying to get into this market, but you just can't find a good deal, we know that pain. We do have opportunities to actually put capital to work pretty quickly in this high demand market. So you have to qualify. You have to be either a sophisticated or accredited investor. You go to peoplescapitalgroup.com to fill out that application and see if you do qualify. We'll be in touch with you. We'll set up a call. You can talk with me and we'll see if you're qualified to invest with People's Capital Group. I'm going to put that actually in the chat here as I answer some questions. And let's see what questions we have to answer right now. Again, if you have any other questions, I'd love to hear them. All right. So degree of risk, how do you measure it? What is your metric? So our degree of risk, what that statement was about, it was essentially explaining that there's different levels of risk in real estate, like new construction tends to be higher risk. Emerging markets can be higher risk as well. So what we mean by degree of risk is, what are you comfortable with? What are you going to diversify into? And, do you want something with a little more risk, but more reward, or something with less risk and a more modest reward? As far as a building, when we're analyzing a building, this question is from Haston. So when your degree of risk, how do you measure it is the question. We have tons of different ways to analyze buildings. We have, of course, cap rate valuations. We have lease loss. For example, we take a 20% lease loss, meaning we take 20% of the net cash flow and throw it in the garbage, assuming you'll be exhausted on something. And that's, in reality, we have about a 5% lease loss, but we underwrite buildings with a 20% lease loss. So we're very conservative when we underwrite buildings. That allows for us to have very conservative numbers, set the bar at an attainable point when we're putting out an offering memorandum to our passive qualified investors. And we have lots of different metrics to analyze a building, but that lease loss is just one example where we put something at 20% that in reality is at 5%. So we put it up to a high level in the bad ways that we water down the numbers even more, make it more conservative. And that's just one level of measure and one metric we use to analyze buildings. If you do want to learn more about that, Haston, go to our website, peoplescapitalgroup.com. Fill out the qualification form, and if you're qualified, we could talk more about this. So you say, I live in New Jersey City. Here's the second question. Because of COVID, a lot of people are breaking lease and not renewing leases. As a result, vacancies have skyrocketed. Where are all these people moving to? Well, probably cheaper areas than Jersey City. Do you think this is temporary? Will they move back? Listen, no one has a crystal ball, right? I don't know what the future holds. What I can tell you is, we've known for years that the best place to invest in real estate is real estate that everyone can afford. Class C and Class B real estate. Jersey City has crazy high prices. The rent is crazy high. It's time for rent to probably come down a little bit in Jersey City. We haven't bought in Jersey City in a few years. We're very focused on Newark, Patterson, areas where you can buy at a discounted price and charge a discounted rent. I'm renting out a 2-bedroom loft style apartment, 2 beds, 2 baths with a huge loft, granite countertops, stainless steel appliances for like $1,500 in Patterson. That's a great deal. In Jersey City, that would be $2,800. So we purchase in more affordable markets that still allow you to commute into New York City in less than an hour. Might even not have the Jersey City zip code or the Jersey City commute, but if you're going to pay 50% of the rent, that's where those people are going. They're going to downtown Newark. They're going to downtown Patterson. They're going to nice areas with well-managed buildings where you can get a better bang for your buck, more real estate for your dollar. And they've been doing that for years. It's nothing new. That COVID has just accelerated it. And of course, other people might be moving out of state or to more rural areas. But for the most part, things will settle down at one point or another. And for the most part, I believe high demand markets like the North Jersey market will stay in high demand long term. Here's another question from Hastings. Does buying rent controlled property even make sense? In what scenario? What are the pros and cons? So yeah, absolutely. You have to know your local ordinances, right? Seth and I, we study local ordinances. We know that in Patterson, rent control does not apply to Section 8. So if you have a tenant paying $950 a month and they move out, you can move in a Section 8 tenant at $1,500 a month, and that doesn't break rent control. So one town over, you go to Passaic, there's a completely different set of rent control laws. You go to Newark, completely different. So you have to know your rent control laws. You have to know how to work with them, how to work with the tenants. We make capital improvements to the building. Okay. So Hastings, we don't just buy real estate and be like, hey, rent's going up. We talk with our tenants. We say, what's wrong with the building? What's broken? You need a new dishwasher. We're going to redo the floors. We're going to improve the unit. We're going to make it a nice, enjoyable space to live. And therefore, the tenants are satisfied and willing to pay a reasonable rent increase. So the first thing we do is find out what's wrong with the property. How do we improve the quality of life at the property? And therefore, have a justifiable reason to increase the rent based on capital improvements, and work within the laws of the rent control, but also respect the tenants, respect what they're saying, and make the improvements to the building as we do, to make sure that there's a reason rent's being increased and people will pay more rent to live in a better unit, to be treated better, to have a response to their issues. If a pipe leaks, we get a plumber out there right away. You can go right online to our app, put in the issue, and it goes right into our system, and boom, a plumber comes out to you. That's a great experience for a tenant, right? That's really cool. And our tenants love this. If you can't pay rent, we're going to work with you on a payment plan. We have a welcome package. We have a very professional way to approach our tenants. Our business is built with happy tenants. Happy tenants equal happy investors. It all starts with respecting the tenants. And if you respect them, they will respect you for the most part. And you will also earn more capital or more rent from the building and more profits from the building. So here's the third question. When are we going to start the Q&A? Okay. How do you personally guarantee a debt? I buy on my personal name instead of an LLC. I'm already, yes. So Hastings, I would not, talk to your accountant, talk to your attorney, but I do not suggest buying income real estate in your name. If you're living in a house with your family, fine. But if you are buying an income property, you're going to have tenants living there. And let's say you forgot to shovel the steps one winter day and it snows and they slip and they fall. Well, they can sue you because you own the property in your name. So you do a property insurance and things like that. But at the end of the day, the best thing to do, talk to your attorney about this. But we've been suggested to always buy real estate in LLCs. All of our buildings are bought in an LLC. We have a new LLC for every building. So if there is a slip and fall on one building, it doesn't affect the other buildings. And listen, things happen, right? We have really good documents. If a step breaks, we get it fixed right away. We have pictures of it. So if a tenant 2 weeks later, when the rent's due, miraculously slips again because the step's broken, well, we have record of that step being fixed. And that's the first step to making sure you avoid slip and fall cases or winning them as well, because things do arise as you have lots of tenants and lots of properties. But tight management control is the key to avoiding lawsuits and issues like that. And then just being prepared. We have great property insurance. We have insurance for our management company. We have an umbrella policy. We have all types of insurances that allow us to protect our investors and protect ourselves as well, life insurance. And this ensures that, if a slip and fall does pop up, which, listen, it's part of the business. That does tend to happen. We're in a very litigious society. Then you're prepared to face that case. And quite frankly, your insurance companies tend to pick it up anyway. And it's really dealt with by the insurance companies. So, okay. So that looks about it for the questions. Let's see a Q&A here. No other questions. All right. So what I'm going to do here is I'm going to paste in the chat the website to go to here to qualify as a passive investor, and that's peoplescapitalgroup.com, and the qualification form there where it says click here to invest. I will put that in the chat here, and that will allow you to click right to that site, right to the qualification form online. We make it very easy for our investors to qualify, and that is the process to get started. So I just put that in the chat there. That's about it for today. I don't see any other questions here. I hope you learned how active investors can become passive and saw the value of investing passively in People's Capital Group. We have very limited opportunities, though, so standing on the sidelines is not going to help you earn that passive income. If you do want to find out if you qualify, go to our website, click the link I just put in the chat here, fill out the qualification form, and if you're qualified, we'll move to the next step. We'll set up a call to talk about a current private offering we have, break down an actual property, an actual private offering, answer more of your questions if you're qualified to invest, and that's the steps to starting to build your passive income with People's Capital Group. So that's it for today. Enjoy your afternoon, and we hopefully can connect with you in the near future. Thank you. Sorry, who is this?
My name is Fiona. I'm a cash buyer looking for multi-family houses in Newark, Connecticut.
Great. We have a website called njfixeruppers.com. We put all of our inventory for sale. We try to be direct to the seller, no daisy chains, and we have a number of properties available on there.
Okay, I guess I'll check it out.
Yeah, it's njfixeruppers.com, and our company's People's Capital Group. But what I'll do is I'll text that to you and get off the phone. All right?
Beautiful. Thank you.
Great. Thanks a lot. Matt needs to water the flowers. They're going to die. He needs to get over there. Like, I have appointments all day tomorrow. I'm not sure how that's going to work. I guess I'll get up early tomorrow and head to Vermont. This is a huge inconvenience. I don't think that link's working. Oh, okay. Let me